We have a question from Mr. C.A. Sushilji. He says, can an NBFC fall into two or more categories? So I think that's a primary question.
Not, not,
Yeah.
not exactly. It has to be one category because see, this investment and credit companies, which is ICC, is a very larger and broader activity. And the basic definition of NBFC ICC is that in case the NBFC is not registered in any other category, then it will be NBFC ICC, which is investment and credit. So this is the not possible that the NBFC can be registered in more than two categories.
No, I understand that. So I think that's a clarity that everyone would want. So basic framework is that you have different types of NBFCs, and depending on so the different categories will have different thresholds or different requirements for registration before RBI. So you'll find that some of these categories have a lower threshold for capital requirement as compared to others to encourage those functions in those entities. And of course, there are some do's and some don'ts that an NBFC can do depending on what category they're registered in.
Namaste. Good morning. Welcome to episode 173 of AAA Weekly Webinar Series. We are continuing with our efforts only because you are also continuing to connect with us. So therefore, you are our motivation. Presently, we are continuing with the education series on NBFCs. And in today's episode 173, we would be discussing the RBI's intent. While the RBI has divided the NBFCs based on their activity, rationale behind it, and also in brief, what are the RBI directions and the regulatory framework which is applicable to all NBFCs based on their activity, major activity. So then in the coming episodes, we would be touching one category of the NBFC, and everything about that category we would be covering in one episode. We also have done so far in our last episodes. In fact, what we have so far learned is the NBFC, basically a financial institution, which is defined as per RBI Act, institution that provides financial services similar to banks, that means giving loans, financing assets, or even investing in securities, but does not hold a banking license. What we have covered in the last, how the NBFCs are different from regulated banks, and also how the RBI has kept this sector as financial institutions, which includes banks and NBFCs together as far as various regulatory frameworks are concerned. RBI's determination and the rationale to qualify as NBFC, how regulations evolved regarding NBFCs since last 50 years, and the three-way classification done by the RBI. And the one is the based on the business activity of the NBFC. The other is the based on the whether the NBFC is raising funds or not, public funds. So the access to public funds is another category in itself. And then the systemic importance. The systemic importance is the latest category which is introduced by RBI. So this is what we have learned. And now, like when we say that the NBFCs, we also would like to say that it may be even housing dreams, or it may be power infrastructure, or it may be even micro borrowers, or it may be even fintech ecosystems. So these are the various financial services categorized as financial services, but has different roles, different risk, different public perception, and therefore there are different rule books from RBI for each category of NBFCs. So this session, we will in fact decode the types of NBFCs based on their main business operations. We will not talk about the systemic importance. We will also not talk about access to public funds or not. We will only talk about the decoding of various categories of NBFCs based on their main business operations, and also the logic behind such category and as adopted by RBI while making these categories, and also exploring in brief what are the regulations and regulatory framework applicable to each such category. So like in broad, we in fact have seen in the earlier episodes also, the RBI has classified NBFCs by their primary business activity. Now, when I say primary business activity, that doesn't mean that the NBFCs cannot do other activities which are not the primary business activities. In fact, the NBFCs can do other activities also, but the primary business activity is defined for each category. Now, let us understand one which is a very, very popular and the most important category, which is investment and credit company, in short, NBFC ICC. Then we have the housing finance company, again, the largest segment, second largest segment, it is the housing finance company, means NBFC HFC, infrastructure finance company, IFC, infrastructure debt fund. As we've seen, infrastructure debt fund only finance those projects, those infrastructure projects which are in operations at least for 1 year. Then we have the core investment company, which is more or less a group holding company. Then microfinance institution, which is only to cover the rural and Mahajani lending. And then NBFC factoring, the bill discounting, factoring services. Then mortgage guarantee company. Then the standalone primary dealer. Then non-operative financial holding company, and NBFC account aggregator, NBFC peer-to-peer lending platform, which is NBFC P2P. So these are 12 categories of NBFCs based on their primary business activities. So this is that we will be discussing in brief these categories. So in case we let us start in brief, like this investment and credit company, NBFC ICC. This on 22nd of January 2019, in fact, the RBI released a notification where the harmonization of non-banking financial companies category. So under the RBI has in fact decided to merge 3 categories of NBFCs pre-2019. In fact, pre-2019, the investment and credit company category was in fact not there. In fact, instead of this ICC, there used to be 3 categories. One is the asset finance companies, that is AFC, which is the company which finances tangible economic assets like vehicles, machinery, and equipment. Then the second category was loan companies, which is LCs, provide loan or advances as its core activity, excluding asset financing. And the third is the investment companies, primarily engaged in acquiring and holding securities as its main business. Then all these three categories were merged into investment and credit companies, NBFC ICC. That was done in 2019, 22nd of February 2019. And this pre-2019 structure no more exists. There is nothing like AFC, there is nothing like loan companies, there is nothing like investment companies. All these are merged into investment and credit company. Now, let us understand now in brief what exactly is the NBFC ICC. That means which is a financial institution. In fact, when we call it financial institution, please don't misunderstand. Financial institution, we call it because Reserve Bank of India defines a financial institution under Section 45 I Clause C of RBI Act 1934 as an entity that carries out financial activities as its primary business. So that is the definition of the financial institution. Then comes is the whether it's an NBFC or not, and any financial institutions can be called as an NBFC in case first of all the NBFC must get the certificate of registration, and the certificate of registration as an NBFC can only be obtained if all the compliances are met. So therefore, financial institutions can be any. NBFCs, what kind of NBFC? Fundraising or not, systematic importance or not, that will finally be discussed in case the NBFC gets a certificate of registration from RBI. Otherwise, all these companies which are carrying out the business financial activities as its primary business are called financial institutions as defined by RBI. But a second condition is that it should be registered as NBFC or any other like bank, because see even the banks are also called financial institutions. Even the public financial institutions are also called financial institutions. But subsequent to financial institution, there are categories like banks. In banks also, it can be a public sector bank, it can be a private sector bank, it can be regional rural bank, it can be a cooperative bank. So there are various banks within the bank. Then NBFCs. So there are various NBFCs within the NBFCs. So like when we call a financial institution, first of all, the entity must carry out financial activities as its primary business, and then comes the NBCs, NBFC, ICC. So providing finance, making loans or advances, or even otherwise for any activity other than its own, and the acquisition of securities, is not any other category of the NBFC. So all NBFCs are investment and credit companies in case they are not defined as any other category as per the master directions. Now, to ensure greater operational flexibility and bring uniformity in compliance and supervision, this is what has actually been considered, that it should not be eligible for any other kind of or category of NBFC. If it is not any other category, then it is NBFC ICC, investment and credit companies. Then we have this to ensure the greater flexibility and bring uniformity in compliance and supervision. So therefore, the unified regulations were made for all the asset finance companies, loan companies, and investment companies. So this all was made uniform. And income threshold, which was earlier applicable.
We will wait for Mr. Goel to rejoin. I believe there is a technical issue at his end. Just wait for him to rejoin.
So there was a power failure. So the Wi-Fi, in fact, has to be rebooted. So Ankit, you joined, and anything that you would like to say? Because see, we are today on this 173rd episode, and we are continuing with the NBFCs.
We have a question from Mr. C.A. Sushilji. He says, can an NBFC fall into two or more categories? So I think that's a primary question.
Not exactly. It has to be one category, because see, this investment and credit companies, which is ICC, is a very larger and broader activity. And the basic definition of NBFC ICC is that in case the NBFC is not registered in any other category, then it will be NBFC ICC, which is investment and credit. So this is the not possible that the NBFC can be registered in more than two categories.
I understand that. So I think that's a clarity that everyone would want. So basic framework is that you have different types of NBFCs, and depending on, so the different categories will have different thresholds or different requirements for registration before RBI. So you'll find that some of these categories have a lower threshold for capital requirement as compared to others to encourage those functions in those entities. And of course, there are some do's and some don'ts that an NBFC can do depending on what category they're registered in. The idea, of course, is to protect the people who interact with the NBFCs so that the NBFCs have significant capital such that they can absorb the risk that come from doing these businesses. So we can continue, I believe, and then we can take another round of questions once you have gone through a few slides.
So, like when this harmonization of asset finance and loan companies and investment companies was done in 2019, at that time, all these kind of threshold adjustments were also done. So now there is no other threshold is applicable to asset finance or loan companies or investment companies. The only thing which is the 50-50 test of RBI. In 50-50 test, we have seen that the more than 50% of the assets should be again the financial services assets, and more than 50% of the income also must have been received from the financial services. So that is where it is considered as NBFC. And in case it is not registered in any other category, then it would be NBFC ICC. Then we also see that in this ICC, because since in today's episode we are only trying to touch base with the primary, like what kind of regulation is applicable to the different categories, and then in the subsequent episodes we will be touching with one category, and everything whatever is applicable to that category, that will be covered in one episode. Now we have this non-banking company scale-based regulation 2023, which is recently updated on 17th July 2025. So in this particular master directions, we find various sections for various kind of categories, like the section 7 of this master directions in fact covers the NBFC ICC, and it is also for factors, because the factoring companies and ICC in fact are considered very close to each other as far as these various requirements are concerned. But however, the factoring is separate. So in this process of harmonization, there were some companies which in fact got converted from ICC to factor, or from factor to ICC. So that's where we, in fact, the principal business criteria was applicable. In fact, this chapter 3, which actually is covered in the master direction, it says that the NBC, the ICC must keep its financial assets more than 50% of its total assets, net off by the intangible assets. Then again, the income criteria, and then both these tests are in fact must to be complied with. Though the net owned funds requirement, now the net owned funds requirement as on today for NBCC and NBFC ICC is 5 crore, which is as on 31st March 2025. However, already announced that by March 27, by 31st March 27, even all investment and credit companies would require a net owned funds of 10 crores. So this is another change, because the RBI is in fact strengthening the capital adequacy and the strength of the financial strength of the NBFCs. So this is required to kind of to safeguard creditors and to ensure that the company absorb losses. So this is where the RBI is gradually increasing the net owned fund requirement of various categories of companies. And also, it is very clearly said by RBI that in case NBFC failing to achieve the prescribed level within the stipulated period shall not be eligible to hold the certificate of registration as NBFC. So therefore, it is mandatory for all the NBFCs to raise the capital to 10 crores by 31st March 2027. That is mandatory. And then, like as I said, that they have to qualify for the capital. Then this principal business for, and actually, like again, there were some factor companies, in fact, which got converted. Like we will only handle it when this factoring will come, and otherwise we continue with the NBFC ICC. Now, NBFC ICC, as per the RBI, can what is permitted to NBFC ICC as a business? One, to provide loans and advances, secured or unsecured. Two, engage in asset financing. It can be equipment, vehicles, or machinery. Make investment in shares, bonds, or debentures. Carry out factoring business subject to registration as NBFC factors. But once the NBFC factors registration is done, then all those regulations which are applicable to NBCC factor, that would also be applicable to NBFC. But then it will be considered as a factoring company, and the major primary revenue must come from the factoring activities. So investment in and trading money market instruments like commercial papers, certificates of deposits, then the compliance exclusions. Now, since the NBFC ICC cannot undertake any of the activities reserved for separate NBFC categories or reserved for banks, what are these things that the NBFC cannot do? What are these things which NBFC ICC cannot do? One, that the banking activities like the demand deposits, check issuance. Secondly, housing finance companies where the more than 60% assets are supposed to be the home loan housing assets. Then the microfinance companies where the more than 75% of the assets should be micro loans. Then infrastructure finance companies where there's more than 75% of the assets should be infrastructure assets. And then it should not be a factoring company. It should not be a peer-to-peer. It should not be an account aggregation. So once all these activities are excluded, these are not something that the company NBFC ICC can perform. Now, the real-world examples of NBFC ICC are like Bajaj Finance Limited, India's largest NBFC, and then we also see that this Bajaj Finance Limited do this personal loan, consumer durable financing. They also do the credit card-based financing. Then they also do kind of funding, which is mainly by the then we also have the other ICC includes Shriram Finance, Mahindra Finance. So this is something which is the examples of the categories. Now coming to the housing finance companies. Housing finance companies, again, it is the an NBFC that is primarily engaged in providing finance for housing, either directly or indirectly. This includes loans for construction, purchase, renovation, or improvement of residential property. Then also acquisition of land intended for residential construction. So in case anyone wants to purchase a plot of land and where the house will be constructed, that also will be considered as housing finance. So in fact, how the housing finance companies evolved. In fact, in 1987 and 1988, National Housing Bank was set up under NHB Act to regulate housing finance companies and promote housing finance, and it operated as a refinancing and supervisory body for housing finance companies. During the decade, like between 1990 to 2000, post-liberalization, the sector expanded with private players. Entering the market. National Housing Bank issued prudential norms to strengthen risk control and financial health. In 2019, there was a pivotal shift by way of RBI's press release dated 13th of August 2019, took over regulations of housing finance companies via an amendment to NHB Act, and then HFCs were reclassified as RBI's broader NBFC framework. And in 2020, RBI issued a circular titled Review of Regulatory Framework for Housing Finance Companies. And in 2021, RBI issued detailed master directions consolidating norms for housing finance companies aligning them with other NBFCs while preserving housing-specific mandates. In 2024, RBI released a draft circular titled as Draft Circular on Review of Regulatory Framework for Housing Finance Companies and Harmonization of Regulations applicable to the NBFCs. Now, RBI, in fact, this we will see later what exactly the RBI is not doing for housing. RBI is now going to do for housing finance companies. That we will just see a little later, because we'll come to that finally when we talk about the each category of the companies. Then we will discuss about this housing finance companies in detail. Then we have this infrastructure finance company. This is another primary business activity based category. And on 11th February 2010, RBI amended the non-banking financial, non-deposit accepting or holding companies prudential norms directions 2007 to introduce a fourth category of NBFCs, that is infrastructure finance company. So the birth of infrastructure finance company took place on 11th February 2010. Now, an infrastructure finance company, which is in short, we'll say IFC, is non-deposit taking NBFC that primarily finances infrastructure projects, and it must meet specific regulatory criteria to be classified as an IFC as per RBI. Now, Master Directions, which is Scale-Based Regulations 2023, updated on 17th of July 2025, as latest, as we could see, 17th July 2025. So the directions, like it says that the NBFC IFC means a non-deposit taking NBFC which has a minimum of 75% of its total assets deployed towards infrastructure lending. Now, infrastructure lending in this case is a mix of loan as well as investment. So this is what is provided in directions 5.1.14. It says that the infrastructure lending means a credit facility extended to an NBFC, extended by an NBFC to a borrower by way of term loan, project loan, subscription to bonds, debentures, preference shares, equity shares in a project company acquired as a part of the project finance package, such that the subscription amount to be in the nature of advance or any other form of long-term funded facility for exposure in the infrastructure subsectors as notified by the Department of Economic Affairs, Ministry of Finance. So from time to time, so if there is an infrastructure project, there can be a multiple ways of financing. That can be by way of extending term loans or a project loan or bonds or debentures. So this is a part of the debt. And the other can be preference shares of the equity shares. That is also part of the project financing. So both can be done by the infrastructure finance companies. This is what is the definition. And then the eligibility criteria, as I said, that the 70% of the assets of IFC should be deployed in infrastructure loans and the investment. Net owned funds for such company is the minimum 300 crore. We have seen the net owned funds in the case of ICC. It is like 10 crore, which will be in 2027. Presently, it is 5 crores. However, infrastructure finance company, the net owned requirement is 300 crore. Capital adequacy is more than 50%, and that too with tier 1 capital. And the tier 1 capital should be at least 10%, more than 10%. Out of the total 15, however, 10% can be tier 1 and the rest of the 5% or more can be from tier 2. Minimum credit rating, like rated at least A or equivalent by RBI accredited rating agencies like CRISIL, ICRA, CARE or FITEC. Then no public deposits. These infrastructure finance companies cannot accept public deposits. However, in these infrastructure finance companies, there are some relaxation which is also been given because of the size of the various projects. The infrastructure projects are mostly very large. So therefore, there are some relaxation, like when we say any other NBFC, there is a limit of 15% to a single borrower. That limit is 25 for infrastructure. When we see the other company, there is a limit that not more than 25% can be given to one group of borrowers, which is 40%. The lending plus investment single party, there is a limit of 25%. Here it is 30%. Lending plus investment for a group of infrastructure companies, which is otherwise standard limit is 40%, but it is in 50%. So additional information, like this is the NBFC, IFC will be included in the middle layer or upper layer. That depends upon the total asset size. So the infrastructure loan definition expanded to include laying and maintenance of gas, crude oil, and petroleum pipelines. However, the construction of educational institutions and hospitals, it was removed from the infrastructure loan definition. So the infrastructure finance companies cannot accept public deposit, and the classification of IFC must be supported by a statutory auditor's certificate and approved by the RBI's regional office. There are some examples that I can give for IFCs, like Power Finance Corporations, PFC Limited, Rural Electrification Corporation, in short REC, IDFC, and IIFCL means Infrastructure Development Finance Company, and India Infrastructure Finance Company, HUDCO. HUDCO is another PSU providing infrastructure lending for urban and housing infrastructure. So these entities have consistently deployed more than 70% of the assets into project finance, holding high credit rating and maintaining strong capital buffers. Yes, Ankit, if there are any questions, we can take the questions at this moment.
So one question is from Lalit Maheshwari ji. He says income from financial assets are more than 50% means NBFC gives loans at higher rate of interest. So that's not the case. Income from financial assets is more than 50% would mean that overall for that company, the income that is coming from financial assets is more than the total income. So the company can still have income coming in from other categories, maybe some tangible assets, maybe some other assets. But yes, for it to continue as an NBFC, it should have an income of more than income from financial assets of more than 50% of its own total profits. The interest rate which NBFCs are able to, or rather, kind of charge to its clients for borrowings, are all dependent on their cost of borrowing, dependent on the kind of category that they are in, the kind of so totally depends on what kind of market they are serving. Rate of interest is also very much dependent on the risk that they are taking in giving that loan. There can be NBFCs which charge only 18% and not less than that, but they give very risky loans. There can be NBFCs which charge rates of interest which are competing with banks and as less as that or even lesser than that. We have another question which says that for type 1 NBFC, one of the conditions is not having customer interface. What is the meaning of customer interface here? Lending by an NBFC to corporates, will it fall within the meaning not having customer interface? Does customer mean retail lending or individuals? So that's a question from Deepaji.
No, I don't think there is any such, because see, that may be for account aggregator that we will discuss later, but that is not for NBFC ICC or for factoring or for even any other activity based. There is only one activity which actually can be said that it is only for the fintech kind of the account aggregator. So maybe it is a condition only in those NBFCs. They are only acting as the account aggregator, so they will not have any customer interaction. So we'll come to that later. Next classification, which is the infrastructure debt fund. So this infrastructure debt fund is also considered as an NBFC, and again a non-deposit taking NBFC, which is permitted to. Now this infrastructure debt fund is basically a fund, and it is also considered as an NBFC. Now basically the refinance post commencement operations, like the all this, whatever has been done by the banks, whatever has been done by the infrastructure finance companies. So there is an infrastructure debt fund, or there be an infrastructure debt fund which finances those projects which are already commenced operations and are in operations at least for 1 year. So those are the projects which are refinanced by infrastructure debt fund. The refinance post commencement operations date infrastructure projects that have completed at least 1 year of the satisfactory commercial operations, mostly like this finance tool operation or tool operate and transfer, this TOT projects as the direct lender. Because see, the government and the NBFC and the uh, NHAI, or they were finding it difficult because most of the toll projects were having repayment schedule of say 20 years or 20 years plus. So it was difficult for them to raise kind of, so the asset liability mismatch was seen. So therefore, because of, there are other reasons also, because this is also one of the reasons, that because of the asset liability mismatch, the infrastructure finance companies, after they took risk, after they started in the initial capital and the loan, and once the project starts operations, after 1 year, then it can actually be taken over by infrastructure debt fund, because the infrastructure debt fund will have long-term liabilities and will have long-term assets. So this helps in freeing, this helps in making the bank or the infrastructure finance companies to free their funds, so that they can invest in other infrastructure funds rather than locking their funds into that long-term debt, which may even be 20 years plus. So this was the objective of the infrastructure debt fund. So this, in fact, it was announced in 2011-12 union budget, when the finance minister announced the creation of infrastructure debt fund to support infrastructure financing. In November 21, 2011, RBI issued guidelines for this, and August 18, 2023, RBI released a revised regulatory framework to expand infrastructure debt fund NBFC's role and harmonizing the norms with other NBFCs. Now, presently, the IDF, the infrastructure debt fund, they need to have at least net owned funds of 300 crore, and their credit to risk weighted asset ratio is required to be minimum 15%, and out of this 15%, at least 10% should be tier 1. Permitted activities only to refinance the project which is completed 1 year. Actually, they can lend directly to even TOT, toll, operate, and transfer. And then this is again again asset liability mismatch. As I said, that was primarily the reason external commercial borrowings were allowed, and therefore, like, we will detailed discussion we'll do regarding the prudential norms and everything we'll discuss later. And now we can actually come to the core investment companies. Now, when we come to the core investment companies, the core investment companies are specialized category of NBFCs that primarily hold investment in group companies. Unlike typical NBFCs, we can actually see the CIC, the core investment company, do not engage in lending or financing services to the public. RBI introduced the concept of CIC via a regulatory framework to distinguish them from the NBFCs. That was important because core investment companies, in case they are not raising public deposits, are not really much, not really uh, raising much risk to the public at large. So the master directions, core investment companies, Reserve Bank master directions, as updated on 5th of May 2025. 5th of May 2025 is what it was updated, and CICs are placed in middle or upper layer under RBI's scale-based regulations 2023. Qualifying criteria, the qualification of CIC is holds at least, the CIC must hold at least 90% of its net assets in equity, debt, bonds, preference shares, loans in group companies only. In group companies only. So there is a definition of group companies we'll discuss later. invests minimum of 60% of its net assets in equity and in the investment trust as sponsors of the group companies. Does not engage in other financial activities except permitted ones like parking funds in short-term instruments, government securities, intergroup loans, bank deposits up to 1 year maturity. So that is what is permitted to CIC. Does not trade investments except via block sale from group restructuring or disinvestment. So they can only do block sale. So all these, like there are many examples of CIC, like Tata Sons. So they actually have a lot of investments through investment trusts also. And but they are not allowed. These kind of CICs are not allowed to trade in their investments. They can only sell as a block deals, not as trader. Now, the CIC holds more than 100 crores in asset and access public funds, making them systemically significant and subject to RBI regulations. Now, the CIC with an asset below 100 crores and not accessing the public funds remains unregistered CIC, though still bound by the core limits. So this is what is the CIC, and the minimum capital and leverage norms for the CIC is 100 crore and those requiring RBI registration, and adjusted net worth must at least be more than 30% of the aggregate risk weighted asset. That is what is the adjusted net worth which is required. Leverage ratio not to exceed 2.5 times of owned funds. The CIC should manage debt carefully and align with the government norms. The disclosure and corporate, everything that we will come to later. And there are examples that I said that there are examples of CIC that we can see the as we see this Geo Financial Limited reportedly actually got a RBI CIC registration in mid 2024. That is the Reliance Infrastructure Entity, and also the Tata Sons as CIC or corporate finance entities holding group securities. So they do not lend externally, yet play a regulatory role by anchoring group governance, oversight, and financial stability. So then we can come to the microfinance institution. But Ankit, your indulgence at this moment is required, because see, today we are only discussing the various categories in brief, and then we will be discussing whatever is applicable to each and every category in subsequent episodes. What exactly you would like to add here, because we are just at this stage, like even otherwise, in case we have gone through the judgment that has been kind of reversed by Supreme Court again, so giving a relief to insolvency, and the trust on insolvency seems to have come back. The resolution applicants, definitely they were scared of a situation, but I think the Supreme Court has reversed it. I think you can add anything which is...
I think everyone is saying that the scare it will remain a bit. It will not totally go away, because many SRAs who are targeting large companies, if they see something like this happening, even once if it happens like this, even after reversal, it still, I think, takes a toll on the confidence of on the regulations and on the process. But I believe this monsoon session, if there is any amendment or any changes that will resolve stuck-up issues in IBC, I think that will be more than welcome. Or, changes that will speed up IBC per se. I think that will be a big change, and that will maybe give a boost to the entire process. Coming back to NBFCs, I see that Mr. Maheshwari is commenting that examples of IFC companies which are given by us are mostly government companies. So I think infrastructure finance is something that is always, pushed by government, and I believe that it is so by kind of natural choice that many infrastructure companies or many infrastructure lending companies have now merged into other entities. In case you look at ICICI, it started as an infrastructure company, but today it is more of a bank. Similarly, you will look at IDFC, you will look at IDBI. So all these entities which were having some kind of private capital or some kind of semi-government autonomous bodies, they had a tough time in managing infrastructure finance because of the high rate of default there, or high rate of issues NPAs there. So I believe that these government entities that we're talking about are majorly lending. If you look at their loan books, the infrastructure finance companies are also majorly lending to state-owned or state-guaranteed bodies. So they will give a loan to any state discom, which is kind of making some expenditure on state distribution. So that ways, I think they're well protected against those kind of issues. It also allows the government to multiply the lending that is available for those purposes by state government entities. So through these IFC companies, they're able to multiply so they can invest 300 crore capital, but maybe 300 crore capital will allow them to lend as much as maybe 2,500 or 3,000 crores to various entities. So that's the idea there. And then I believe we can see that this question is that if registered NBFC ICC category made all investment and loan to group companies only, whether it has to convert itself into a CIC as investment if the loan to the group exceed 40%. So that's a question that we can answer, that whether this conversion will be
First of all, it will be a non-compliance if it is done without getting the registration changed. So if there is a requirement that it cannot invest more than 40% into the debt and equity or preference of the group companies, then it has to be applied before there is a likelihood of increasing that exposure.
So in case the promoter of that NBFC thinks that, no, I don't want to give loans to outside entities now, I have this NBFC and I would want to rather give loans only to my group entities or invest only in group entities now, so they can change the purpose.
They can change. Certainly they can change, but then it is subject to RBI approval. They can change, and in case they fit into the requirements, then of course they will also fit into the already complied regulations.
Right. We have another question from Mr. Kedia, whether CIC can trade in share market up to 10% above 90% mandatory to be in group, which is not a block deal.
Not allowed. The trading is not allowed to CIC. Probably the CIC structure was made only because of the insider trading, to protect insider trading. And I think even the other investment is also restricted.
I think what he means is that trading in stocks which are not relating to the group.
No, I think that company is not allowed, because even if they have to keep their surplus funds, it is only restricted to government securities and the specified investments, which are primarily 100% safe. And all there is a difference in, because all these CICs can raise funds from public at large. So therefore, the protection is also required.
We have a question from Rajan Ji. He says, one non-deposit taking NBFC has invested its fund in group companies as well as provided loans to group companies. Whether it will be exempt from 5 crores and 10 crore net worth criteria or NOF criteria. So they will be classified as CIC. Yeah, in case they have given loans to group companies, or in case they have made funds or invested funds.
For CIC, there is a minimum requirement of 100 crore.
So if a company has a net worth of or an NOF of 10 crores, can they give loans to group companies? No. So we can check on that.
Giving loans to group companies, well, I think we also will have to just go through, because see, the entire subject is so large, because it will be covered in 10 episodes, and we are in fact we are also going step by step. So this question is very important. What happens to those entities or companies which are presently not NBFCs registered, and they have a capital of more than 5 crores, and they are only investing in their group companies? So whether those would be NBFCs, ICC, whether they would require a COR or not, certificate of registration or not, with one rider that they are only investing in their group companies. So this is a good question. Give us some time, we'll come back.
So those are the questions that came to me from the participants.
Quickly go micro, especially in rural and goal is financial inclusion through small ticket loans without collateral. Microfinance loans as collateral-free household loans to families with annual income of up to rupees 3 lakhs, with installments not exceeding 50% of monthly income. Borrowers are often women in rural and semi-urban area. So that is what is the definition of microfinance. Their origin started in 1974. Their journey started in 1974 with the establishment of Seva Bank in Gujarat by the Self-Employed Women Association, offering financial services to poor women. In 1980, informal lending models, self-help group, and schemes such as differential rate of interest DRI and integrated rural development program emerged to serve low income households. In 1990, inspired by the global models, notably by Grameen Bank in Bangladesh, Indian NGOs began offering small collateral-free loans to poor households, particularly women. In 2000, as outreach expanded, several NGOs converted into NBFCs to access capital market operations. These evolved into for-profit NBFCs, NBFC, MFIs, with some major early events including SKS Microfinance, which later became
Yeah, we can see the screen now.
So again, I think we'll start it where we left. And in fact, we can see also the video. So this was then the company was Equitas. However, they operate under the general NBFC's regulations with no dedicated microfinance framework from RBI. So in fact, thereafter, in 2010, in fact, Andhra Pradesh crisis was seen and microfinance institutions crisis erupted due to allegations of coercive recovery practices, overlending and multiple borrowings from different microfinance institutions. This led to borrowers' suicide, massive defaults, and erosion of trust in this sector. It triggered regulatory scrutiny, highlighting the need for a uniform regulatory framework. Therefore, RBI intervened in 2011. Following the Malegaon Committee report in 2011, RBI on 2nd July 2012 introduced the category of non-banking financial company, microfinance institutions, and in October 2021, in fact, RBI issued a master directions regulatory framework for microfinance loans applicable from April 2022 to all these like banks, the state financial borrowers, NBFCs, NGOs, and it is now applicable to everyone. That is since 2000, like April 2002. Regulatory framework, as I said, then the eligibility criteria, as I said, that they be registered with the RBI. Asset composition, like at least 60% of the net asset, previously it was 65%, must consist of the qualifying assets, and the quality said that the unsecured loans to households with annual income up to 3 lakhs, urban or rural, loan must be used for income generating purposes. Although not exclusively mandated now, loans must be collateral free with no security taken. loans must have repayment via periodic installments, weekly, fortnightly, monthly, and the income threshold, in fact, is 3 lakhs for rural, and for urban, it is again like metro, it is again up to 3 lakhs only. There is no change. In fact, unified the threshold introduced in 2024. Earlier, it was 1,25,000 for rural and 2 lakh for urban, but now it is 3 lakh for both. So again, for other things, we will come later, and the all this fair practice, everything that we will come later, and we will now see the NBFC factors. In fact, we are up with the time. We should not continue beyond. In fact, every participant has some kind of other engagements. So we would like to conclude this today. And in the coming episodes, we would be discussing the category-wise everything applicable to that category, including prudential norms, eligibility criteria, non-compliances, various compliances required. So all that we will be covering in one particular episode for one category. Yes, Ankit.
Yes, I think we can wind up for today, and we can then continue with this very exciting and interesting topic from the next session. Thank you, everyone. Thank you so much.
Thank you very much. Thank you very much.
Thank you, everyone. Thank you.
So as we always say that it is our way of learning. We are also learning along with you. Thank you.